Welcome back, everybody, to Multifamily Report, market news, industry updates, and investing insights for you, the multifamily investor. I'm your host, Travis Watts. In today's episode, we're going to be covering inflation, the impacts of inflation to the real estate market, what we've seen last year, this year, and then looking forward, what we might expect for 2023. I'd like to just start with acknowledging that multifamily apartments are a very resilient asset class. And we know this statistically from looking at past recessions, the dot-com bust, 2008 to 2010, the pandemic and the onset of that. Multifamily in general tends to perform well in uptrending markets, stagnant and flat markets, and even in declining markets. And we're going to uncover why that is. In fact, according to CBRE research, if we look at the national scale, multifamily pre-existing Class B apartments during the Great Recession, 2008, 2009, 2010, average rents only fell by about $125 per month. And, the recovery was quite quick. You can see here on the chart that once rents bottomed out there, the recovery was quite quick. It was less than 2 years to get back to the rent pricing that we had before the recession. So how about today? What's happening right now? Well, one, the government CPI reading, and CPI stands for Consumer Price Index. You can learn more about this, and you can see all the updated stats and facts at bls.gov. Well, basically, we've been running 8 to 9% annualized inflation, meaning that the cost of goods, services, housing, et cetera, is all packaged into a basket of goods, essentially. They look at that every single month and they say, how much was it a year ago? How much is it today? And then that's how they come up with the annualized inflation. We have been running hot and heavy on inflation between 8 and 9% annualized for the majority of the year here in 2022. And while inflation is not necessarily good news to the consumer, it's increasing your grocery store bill, it's increasing the price at the pump and all things around you. It actually can be a bit of a positive to multifamily and real estate investors at large. That's what I want to dive into. So you may have seen headlines this year, even last year, like the one here shown on the screen by Market Watch, stating that home building costs have risen at unprecedented rates. In fact, the bill for materials required to build an average size new single-family home have increased 42% from 2018 to 2021, making material costs roughly $35,000 more. So with inflation pushing up the price of materials and the cost of labor, pre-existing real estate tends to follow the upward trend. And again, this can actually be a benefit to real estate investors, especially in the multifamily space. As single-family homes get more expensive, more people get priced out of the market, more people need a place to rent. We have a severely low supply of affordable, safe workforce housing. And with inflation as high as it is, rents tend to follow the trend. You can think of it like this. Let's say a real estate investor decided in 2020, a couple years ago, to buy a single family home and rent it out. We'll say they paid all cash and they charged $2,500 each month in rent. And just to use some simple math, we'll say that their expenses and overhead of owning that property are $500 per month. So what that essentially means is it's netting them $2,000 per month. If you times that by 12, you get $24,000. And then if you take $24,000 and you divide by the purchase price of the home, which is $300,000, that gives you about an 8% annualized return. So if the housing market goes up, like we've seen over the past 2 years, and now that investor's looking at selling that property for, say, $400,000, what that means is, assuming another investor is going to come in and buy that property at $400,000, now they have to get creative and figure out how they are going to make a profit. And if that next investor decided to buy that property at $400,000 and chose not to increase the rents, they would be looking at a 6% annualized return as compared to the 8% annualized return that the previous investor had. So, in order to get back to an 8% return, assuming that's their goal to achieve, then they would need to effectively raise the rent to $3,150 a month. We'll plug in the same example as before. We'll say there's $500 a month in holding costs. So that brings their net profit to $2,650 per month. If you times it by 12, that's $31,800 annually. And then finally, if you divide by the purchase price of the home being $400,000, that gets you back to an 8% annualized return. So the takeaway here is with high inflation, rents tend to increase. But what we're talking about here so far is just the market itself and rents going up because of inflation and the cost of goods and services increasing. What we haven't yet talked about is what about a value add real estate business plan? What value add means is that you're essentially adding value to the residents and to the property. Some examples of value add would include renovating units, renovating common areas, renovating amenities like pools and gyms and dog parks and barbecue areas, and essentially making a multifamily community, in the example of multifamily, a better, safer, and newer place to live. And because the residents have a higher quality of life, you can justify, in many cases, raising the rents because of that. After all, it's modernized, it's remodeled, it's now competing with brand new properties. This is yet another way you can potentially benefit from an inflationary environment with real estate. Now, of course, it's not all good news out there. Inflation's running at 40-year highs, and interest rates as of today are nowhere near where they were even in the early 2000s, around 6.5%, or the all-time highs of 1980. So to help tackle inflation, the Federal Reserve has been raising rates all year long, and they have suggested that there's more rate hikes on the near horizon. And the negative news about that is the higher interest rates go, the more borrowing cost gets put onto buyers. So much like in the previous example of the investor buying the $400,000 single family home, if interest rates keep rising, they have to get creative and find ways to be profitable. When mortgage rates increase from 3% up to 6%, like we've seen over the past year, it makes buying real estate more expensive. So if we consider a 30-year fixed rate mortgage, we'll say the balance is $300,000, and we plug in a 3% annualized interest rate, that payment's going to be somewhere in the ballpark of $1,265 per month. Now, if we took the same 30-year mortgage, fixed rate, same balance, but we changed the interest rate to 6%, now the payment has just increased to $1,799. So this is what we're experiencing this year in 2022. And it leaves investors with really two options to consider. You could either look for a discount or ask the seller to reduce the price of the property to help offset that additional carry cost because of higher interest rates, or you could proceed and just buy the property anyway, and then look into how you could effectively raise the rents to help offset the higher interest rates. So the first option obviously is negative for real estate, because if everyone starts cutting the prices and bringing the prices down, then those become comparable sales, which makes everybody's real estate a little bit less valuable. But the second option in terms of raising rents is the opportunity for investors this year. And a few things to consider if you're going to be investing in 2022 and looking forward to next year is, number one, understand that real estate is local. For example, if we look up the stats of 2021, you'll see that San Francisco multifamily only saw about a 4% annual rent growth, whereas Tampa, Florida, saw more than a 20% increase in rents, according to Yardi Matrix. Additionally, the type of business plan that you consider is also very important. For example, with existing multifamily that already has tenants and renters in place, you have the ability to potentially raise rents. Whereas a developer does not have renters at the moment, and they have higher interest rates to consider on any construction loans. They have higher labor costs to consider. They have supply chain issues that are happening worldwide. And if the Fed continues raising rates even more, then it lowers their potential selling price down the road. And last but not least, the type of real estate you choose to invest in matters a lot as well. So you've got multifamily, you've got self storage, you have hotels, you have medical offices, you have industrial, you have mobile home parks. These are all under the category of real estate, but these asset types are very different. For example, office rents were up 1.2% year over year in August of last year. At the same time, multifamily rents were up over 10% nationally in August of last year, this according to Yardi Matrix. So, in recap, inflation simply is what it is. It can be good or it can be bad depending on your perspective and your particular investment strategy. So, I want to thank you guys so much for tuning in to another episode of Multifamily Report. My name's Travis Watts. I'm your host. If you ever have questions about investing in multifamily apartments, anything I left off in this episode you want to know more about, you can reach me at travis@ashcroftcapital.com. Thanks so much for watching. Have a great week. We'll see you in the next episode.